Welcome to ASL's tax webinar. Today's topic is U.S. tax reform and its significant impact on international tax provisions. I'm Jyothi Chillara, Senior Manager at ASL. I've been practicing tax for more than 20 years. I work mostly with emerging mid to small privately held companies and individuals with cross-border transactions. With me on this panel is Erika Diebert, who's a tax manager at ASL. But before I hand it over to Erika, there are some housekeeping items. Please use the Q&A feature in the top right corner of the screen, and we will answer questions at the end. You can also print or save the slides. Click the multimedia button in the top right corner, and it'll bring up the presentation. Some people have asked us about the CE credit. Unfortunately, we will not be offering the CE credit for this presentation. And if you have to leave early or you would like to share the presentation with a colleague or friend, the webinar will be posted to our YouTube channel within a few days. A brief survey will pop up at the end of the webinar. Please complete it. We truly appreciate your feedback. We have a couple of upcoming webinars. One is on Tuesday, February 6th, 2018, tax reform and impact on real estate. The other one is on February 7th. It's tax reform for pass-through entities. Both are around the lunch hour, noon. So Erika will talk about the international tax provisions pre-law and the changes, some of the changes that the new tax law has passed.
Thanks, Jyothi. I am Erika Diebert, and as Jyothi said, I'm a tax manager here. I am coming up on 10 years worth of tax seasons. My practice has become really centered around international activities. I'm part of the international niche here as well as the tax provision group. So now on to why we are really here today, and that is to discuss the impact of the new Tax Act on the international tax law. Specifically, we're going to talk about the new tax system versus the old. Then we're going to go into specifics of the new tax law, including the participation exemption for dividends from foreign subs, the transition tax of repatriated earnings, global intangible low tax income, or GILTI, and the deduction for foreign-derived intangible income, or FDII. And then Jyothi's going to round it out with a few other provisions that are going to impact international tax law. So as an introduction, we're going to kind of compare and contrast a little bit of the old tax system versus the new tax system. So under the old international tax regime, U.S. citizens, resident individuals, and U.S. corps were subject to U.S. tax on a worldwide basis. This meant that all income, regardless of where earned or sourced, was taxable in the U.S. Although this was true, there existed a deferral opportunity for U.S. shareholders of foreign corps. The foreign corp earnings were generally not taxed until the income was distributed as dividends to U.S. shareholders. This deferral opportunity is what has encouraged large U.S. corporations, not even large, any U.S. corporations, to hold billions of dollars offshore. As long as they left this cash and assets offshore, the income remained untaxed in the U.S. So now, on to our new tax act, our new tax system. So the new tax act shifts from a worldwide system to a somewhat territorial system. This new system is anchored by the creation of a dividends received deduction or participation exemption. Multinational corporations will now be able to repatriate these foreign earnings tax-free. This creates a territorial tax system, as the U.S. will generally tax income earned within its borders and exclude income earned without. But as noted above, it's a somewhat territorial system. So there are provisions in the law that require foreign earnings to be included in income under certain circumstances, most notably if the foreign income is taxed at low rates. There's also restrictions on the type of U.S. shareholder that will be able to benefit from some of these territorial tax benefits. So although this shift to a territorial system occurs, there is first a resetting of accumulated and untaxed earnings sitting in foreign corps. There will be a one-time deemed repatriation of earnings that will occur for most taxpayers in this current 2017 filing season. So Jyothi is going to go into more detail on the dividends received deduction as well as the repatriation of earnings.
So as Erika mentioned, the new law changed the taxation of domestic corporations from a worldwide tax system to a quasi-territorial system by establishing a limited participation exemption. So what does that mean? U.S. corporation that owns 10% or more of a foreign corporation will get a 100% deduction for the dividends distributed by the foreign corporation. There are certain requirements. The foreign corporation stock must be held for more than a year. Hybrid dividends do not qualify. And to prevent a U.S. corporation from receiving a double benefit, no direct or indirect foreign tax credits would be allowed with respect to the exempt dividend. This kind of makes sense because on any given amount, you don't get a deduction as well as a credit. Now, this law is effective for distributions made after December 31st, 2017. There's also a participation exemption that applies for any deemed dividend on sale of the foreign subsidiary stock. There are a couple things to note that this deduction is only available to a U.S. C corporation, as I mentioned above. It does not apply to S corporations, partnerships, and individuals.
Now, Jyothi, do you think that the individuals and the pass-through entities are being excluded from this dividend received deduction because of the 20% pass-through deduction that's now available?
So I think I've read somewhere that some experts are actually speculating that it is the case, but if you think about it, it's not an equal benefit. The 20% pass-through deduction is not kind of equal to the 100% dividend received deduction.
Right. So the pass-through entities are really losing out on
Yes.
this benefit.
Yeah. So moving on, we have all heard in the news about Apple that it is planning to bring back about $252 billion of cash and pay about $38 billion in taxes. Now, other companies like Cisco, Microsoft, etc., are expected to follow the suit. This is because they're taking the advantage of this one-time repatriation tax passed by the new tax law. This is to encourage the companies to bring back cash held offshore and to spur investing and create jobs in the U.S. The new law includes a transition rule to affect the participation exemption regime. There is a one-time mandatory tax on the accumulated earnings of the foreign corporation. Now, this is being referred to as the transition tax or the toll tax. Now, who is subject to the transition tax? A U.S. shareholder of a specified foreign corporation is subject to the tax. Now, who's a U.S. shareholder? A U.S. shareholder can be an individual, corporation, S or C, trust, a state that owns 10% of a specified foreign corporation. Now, a SFC, or a specified foreign corporation, is any controlled foreign corporation and any foreign corporation with one or more domestic corporations as a shareholder. So we have many, many definitions here. The effective date of this law is 2017 tax year for a calendar year U.S. shareholder that owns a foreign corporation with a calendar year end, and it is 2018 for a U.S. shareholder that owns a foreign corporation with a fiscal year end. There are about three components to the calculation of the tax. One is accumulated earnings and profits, or earnings and profits, which I'll refer to as E&P going forward, tax pool, and cash equivalents. So the earnings and profits measurement is the greater of E&P as of November 2nd, 2017, or December 31st, 2017. The IRS has recently released a notice which said that October 31st is okay for the November 2nd, 2017 measurement. You can prorate the additional 2 days based on the balance of the E&P on October 31st. The cash measurement is a greater cash balance as of December 31st or average cash balance for 2015 and 2016 years. So cash and other liquid assets on the foreign corporation's balance sheet are taxed at a 15.5% rate, and all the other earnings are taxed at an 8% rate. Now, we have a very quick and dirty example for you. In this example, we have a U.S. corporation that owns 100% of the foreign corporation, and both the corporations, the U.S. as well as the foreign corporation, are on a calendar year end. So the foreign corporation's earnings and profits, the highest balance is $1,400. The tax pool is $150. Tax pool is nothing but the taxes, foreign taxes paid on the earnings and profits of the foreign corporation. The highest cash balance is $1,200 in this example. So what is our repatriation income? It's $1,400. That out of which $1,200, which is the highest cash balance, is subject to the 15.5% rate. Now there's a participation exemption deduction for the cash portion, which is at 55.7%. That translates to $669 deduction, and the amount that is subject to the 8% or the non-cash portion is $200, $1,400 minus $1,200, $200, and the participation exemption deduction on the non-cash portion is 77.1%, which translates to $154. So the inclusion amount is $577. After applying the tax, the highest rate of 35%, and the prorated foreign tax credit, your total tax is $162. So for the repatriation income of $1,400, you're paying a tax of $162. So, I mean, it translates to an effective tax rate of 12%.
Mm-hmm. So the participation exemption deductions that are in there are a little bit confusing, but the way I understand them is you're just backing in to the deduction, into the deduction that makes the total inclusion equal to the 15.5% or the 8%. So it's a backwards kind of calculation.
It is,
right?
it is, yes, that is correct. So we do have a special rule. Oh, now this tax can be paid in 8 installments. And if the election, you have to make an election to pay the tax in 8 installments. Now, if the election is made, the first installment is due, for example, for the 2017 return, it's due on April 15, 2018. So this is something that all of us need to consider for now, right?
Mm-hmm.
Yeah.
Yeah, these elections will be really important in the 2017 filing season.
Yeah. There are some special rules for S corporation shareholders. The S corporation shareholders can actually defer the tax liability until the occurrence of a triggering event. And what is a triggering event? The triggering event is if the shareholder of the S corporation transfers any of the shares of the stock in the S corp, a liquidation sale, or if the S corp converts to a C corp, right? So
does the S corp actually calculate the tax on where? I mean, practically speaking, how is this going to work?
So the S corp is required to report the repatriation amount as well as the amount of deduction to the shareholder. And so the shareholder actually elects to defer his or her portion of the tax liability. So if there are 3 shareholders, one can pay and the other 2 can elect not to defer it. Basically.
So it's on a shareholder by shareholder basis.
Yeah.
So depending on their specific tax situation, each shareholder can choose to defer the tax or pay it in that year depending on what their situation is.
Right.
Okay.
Right.
That makes sense.
So before we go and talk about GILTI, the takeaways are transition tax is going to become very important for the 2017 filing season. We do encourage all of you to talk to your CPA, which is us, about the legal structure of your entity, and also talk about we will all have to do some kind of E&P studies of the corporation so that we are calculating the tax on the right amount.
Right. Here at ASL, we have a team that's put together that's accumulating everything that we need to handle this transition tax for the 2017 filing season. So we're going to have specific worksheets and things like that that are going to help this process move a little smoother. So we're on it. Definitely work with us, but we're going to be ready for it.
Yeah. So Erika is going to talk about the GILTI tax as well as FDII.
Okay, so this is the portion of the law that gets very complicated very quickly. There are a lot of new terms, new terminology that have been introduced with this new tax act. So as I'm going through this, and you find yourself saying, what is she talking about? Don't worry. We will go through an example. I'm going to kind of run through it as definitions and the calculation, but in the end I'll have a calculation, a simple example that hopefully will bring it home and kind of make it a little more clear if that's possible. Okay, so here GILTI. GILTI is a provision that subjects the earnings of foreign corporations to U.S. tax. This is a section of the new Tax Act, which I alluded to earlier, that makes the new tax system a partial territorial system, because the earnings of the foreign corporation will be taxed in the U.S. under certain provisions such as GILTI. So it applies to 10% or more shareholders of any controlled foreign corporation and is effective for years beginning after 12/31/17. So we aren't going to have to really dive into this for the 2017 filing season, but we want to be ahead of the ball. We want to start the planning on this because it is going to affect the 2018 tax return. So the calculation is done in the aggregate. So for a U.S. shareholder with multiple CFCs, a total of all the CFC activity will need to be considered for this calculation. So the calculation of GILTI is based on a formula that I'm going to go over in the coming slides. This formula excludes income that is deemed to be a return on tangible assets. It deems the residual income of the foreign entity to be intangible income that is subject to current U.S. tax. So the provision operates in this manner without regard to whether the income in question is in fact due to the exploitation of intangible assets. So it's not a facts and circumstances calculation based on your particular business or entity. It's really a formula-based determination of what intangible income is. So there is a break under this provision for C corporations, and it provides a deduction that reduces the effective U.S. tax rate of income included in GILTI, and I'll also go through that in our example. Okay, so now we're going to run through the actual calculation of GILTI. So here's our first new term. So the calculation, our first step is to calculate the CFC's tested income. And to make it simple, our tested income is essentially the net income of your CFC or your controlled foreign corporation. There are adjustments to this net income, and we've listed them here, but as far as how I'm going to explain it today, we're going to go forward saying it's your net income of your CFC. Just keep in mind there are adjustments to that number. So once you have calculated that net income, you're going to go into step 2, to our second new term, which is to calculate QBI, or qualified business asset investments. What this is a quarterly average tax basis using straight line in depreciable tangible property. So it's really your basis in your tangible property. This is not including your intangible property. Once you've calculated QBI, it is used in step 3, which is you're going to calculate your net deemed tangible income return. What that is 10% of your QBI, 10% of your tangible property basis, reduced by any interest amount that was taken into account in step 1. So that's going to be your net deemed tangible income return. Once you have step 1 through 3, you're actually going to go into the calculation of what GILTI is, and GILTI is your tested income less your net deemed tangible income return. So what that is your tested income, again, is essentially your net income of your CFC less this 10% return on your tangible asset base. And this amount will be included on your income tax return. Now, if you're not a C Corp, that's kind of where it ends. That amount is included on your tax return. If you are a C Corp, there's a few more steps, and that is that there is a GILTI deduction. So this deduction is available only to eligible C corporations, and for taxable years 18 through 25, the deduction is allowable equal to 50% of the GILTI inclusion that we just calculated on the last slide. So the deduction really reduces the effective rate imposed on GILTI income for C Corps, U.S. C Corps. So given the new 21% corporate rate, this results in an effective tax rate of 10.5% on GILTI income. Now, in addition to this deduction, there's also a foreign tax credit available. The foreign tax credit is available only to C corporations, and once the foreign tax attributable to GILTI income inclusion is calculated, 80% of that will be available to use as a credit. So taking into account foreign tax credits, at a foreign tax rates of 13.125 or higher, that's kind of like our magic number, 13.125. At foreign tax rates of 13.125, eligible C corporations will owe no residual tax on respect to their GILTI income. And the way that's calculated is 80% of 13.125 is 10.5%, or the effective tax rate on GILTI for C corporations once you take into account the deduction. So, if I haven't thoroughly confused you yet or overwhelmed you, we're going to go through an example that hopefully clears things up and doesn't make it more complicated. Okay, so our GILTI example here, our facts are our tested income or our adjusted net income of our CFC is $900. The tax associated with that $900 is $100, and our average asset tax basis is $4,500. So that would be our Q-buy. So our GILTI calculation is our tested income less 10% of our Q-buy, or 10% of our tangible asset return. So that's $450, so 10% of $4,500. So our total GILTI inclusion will be $450. That's the amount that's going to need to be included on the tax return. So then to go into our foreign tax credit calc, our inclusion percentage is 50%, and that is $450 of GILTI inclusion against our total tested income of $900. So 50% of it is going to need to be included. So we get to consider 50% of our tax pool, 50% of 100. So our foreign tax credit available would be $50. Of that, 80% we'll be able to actually take a credit, which is the $40 there. So our total GILTI inclusion, which we'll have to gross up by our foreign tax credit available of $50. So the total GILTI inclusion and FTC will be $500. So that amount will be included on the tax return. 50% deductions, or total taxable amount associated with GILTI, will be $250. At a tax rate of 21, we'll have total tax of 52.5, which equates to 10.5% on the GILTI inclusion amount. We'll get the 80% FTC of $40, and our residual tax will be 12.5. So this is a very simplified calculation of GILTI, but it kind of outlines the process that will need to happen in order to include this on the tax return and calculate the tax. So who does this really impact? So who it's really going to impact are shareholders of foreign corps that have low levels of depreciable assets, tangible depreciable assets. So that's really going to be our tech companies and our service providers, and we do have quite a that. We have a lot of that here in our practice. So it's going to affect our clients and possibly those of you who are listening. Probably that's why you're listening. So this is going to impact your 2018 return. And I think who it's really going to hurt is our individual shareholders and investors that flow through entities of foreign corps, because they aren't going to be allowed the 50% deduction on GILTI, and they're not going to have the foreign tax credit. So this is where the conversation really needs to be had involved with structuring. There's a lot that goes into this.
So, we've been kind of getting a lot of questions based on the lower corporate tax rate is now 21%. So a lot of S corporations and pass-throughs have been asking us, should we convert to a C corporation? Now, when I hear about GILTI also looks like there are more benefits for a C corporation. You get the deduction, you get the 80% foreign tax credit, and all of that, right? So do you think this GILTI will prompt entity conversion?
Yeah, I mean, it's completely possible. And like I said, the conversation needs to be had. But double taxation, I'm sure everybody, has heard about the double taxation. It's been around forever of C corporations. It's taxed within and it's taxed when the dividends come out to the shareholders. That's still here. That did not go away with the new Tax Act. So there's still that issue, but it's really specific to everyone's business and everyone's model, whether or not a conversion would benefit them. And another factor would be how you treated your repatriation. As an S corporation, that shareholder was able to make an election to defer the impact of having to repatriate all those earnings and that tax. Right. So if you convert to a C corp, all that tax is going to become immediately taxable or immediately owed.
It becomes a triggering event.
Exactly.
Right?
So there's a lot of steps that need to be considered on a conversion. But definitely the conversation needs to be had, and a lot of things could factor into that depending on your specific business.
Yeah, I agree. I think it has to be evaluated on a case-by-case basis.
Definitely,
right?
Yeah. So now on to a little bit of a brighter note, again, if you're a C Corp, is foreign-derived intangible income and its associated deduction. So the deduction associated with foreign-derived intangible income is equal to a percentage of this FDII, which we're going to calculate. And again, I'm sorry, there are a lot of new terms, and so it might get a little complicated, but again, we have an example at the end, so if you find yourself tuning out with all these new terms, we'll have the example at the end to bring it together. So the deduction that was put in place associated with FDII was to minimize the incentives to move and hold intangible assets outside of the United States. So the deduction really reduces the effective U.S. tax rate for eligible C corporations on foreign-derived income treated as attributable to intellectual property and other intangible assets. So FDII is generally the portion of a U.S. corporation's net income that exceeds a deemed rate of return of tangible depreciable property assets. And as I go through the formula, you'll see it's very similar to GILTI in that it determines a tangible property return at 10%, the same as GILTI does. So this formula-based approach determines the income attributable to intangible assets. So eligible C corporations are allowed a deduction equal to 37.5% of this FDII for 2018 through 25 tax years, and we'll go through the calculation here in the coming slides. So our first step to calculate FDII is to calculate the deductible eligible income, another new term. And again, to simplify it, it's your net income of your U.S. Corp adjusted for certain items that we've listed here on this slide. But going forward, again, for simple reasons, we're going to say that this is the net income of the U.S. Corp. So once you've calculated that, step 2 is to calculate how much of that net income is derived from foreign sources. So to be derived from foreign sources, the property must be sold to a non-U.S. person for foreign use, or services must be provided to any person or property outside of the United States. So step 1, net income. Step 2, how much of that net income is foreign derived. Then, once we have those amounts, we move on to step 3, which is to calculate the deemed intangible income, another new term. So you're going to take your DEI, which we've calculated in step 1, which is our net income. So you're going to take your net income of your U.S. Corp and reduce it by 10% of your tax basis of qualified tangible business property. Similar to GILTI, same thing. They're saying that 10%, you're getting a 10% return on your tangible property. And anything above that in your net income, they're attributing to intangible property. So it's being produced by intangible assets. So once we have step 1, 2, 3, we move on to the actual calculation of FDII. And that FDII calculation here is your deemed intangible income times essentially your foreign income percentage. So DEI was step 3, which is your total net, your 10% return on your tangible property, your net income less 10% return on your tangible property times your foreign income percentage. So it's your total foreign-derived income over total income. So that's going to calculate your FDII, and then the deduction associated with that will be 37.5% of this FDII calculation. So your effective tax rate of FDII is 13.125, and you can see there on the slide how we calculated that amount. So now to go into an actual example of the FDII. So the net taxable income, or that was our step 1 calculation, or net taxable income of our DEI amount is $1 million. The foreign-derived portion of that $1 million is $200,000. Our qualified business asset base is $2.5 million. So our DEI, our deemed intangible income, is $750,000, and that is calculated as $1 million of net income less 10% of our tangible asset base, 2.5, or 10% of our QBI, and that's $750,000. So our FDII calculation is equal to $150,000, which is our $750,000 deemed intangible income times our foreign income percentage. So our $200,000 of foreign-derived income over our total income of $1 million. So our FDII calculation will be that $150,000 times the 37.5%, or $56,250. So our effective tax rate on FDII again comes down to the 13.125, and you can see how that is calculated in the example here on that last line. So again, this FDII is available only to C Corps, so it brings up the same discussion of possible conversions. It's another added element to what you need to consider to, in a possible conversion, and whether or not that is really something that would benefit you and your business.
Also, I think the name itself is kind of misleading, right? Because it says foreign-derived intangible income, but it applies to the sales of property and services outside of U.S. So
yeah, the name is really misleading, because when you first read it, you may think, I don't have any intangible income.
Right.
But it's not, again, it's not a facts and circumstances calculation. It doesn't look into your business to determine whether or not you do actually have intangible sales. It is calculating that you are getting a 10% return of your tangible property, and anything else within your business is deemed to be derived from intangible sources. So if you may think, I don't have any intangible income, but this formula-based approach may be determined that you do according to this formula. So it's something that every business with foreign sales of property or services really needs to consider.
Also, the new law has repealed the domestic manufacturers deduction, which was a 9% deduction for any manufacturing activity that was done in U.S. And now this FDII has come into place. I mean, even the base of the calculation is completely different.
I guess it's kind of aiming at the same, trying to create the same incentive to have U.S. corporations have their business here, keep their assets here, and sell overseas. So it's aiming at the same thing, but again, it is it is limited to C corporations. So pass-throughs and individuals really lost that manufacturing deduction and aren't benefiting from this FDII deduction. So it wasn't really a trade-off that was fair to everybody.
Yeah. So something to consider when you're planning entity conversion.
Definitely. Yeah, this is one more element that needs to be considered.
Right. So moving on, we have a couple of other international tax provisions. One is BEAT, Base Erosion and Anti-Abuse Tax. This applies to U.S. parented and non-U.S. parented multinational corporations with 3-year average annual gross receipts greater than $500 million. So in a sense, BEAT is an alternative tax computation. The U.S. company is required to pay the greater of its regular tax liability or its BEAT tax liability. There are several changes to the foreign tax credit rules, like separate foreign tax credit limitation for branch income, repealing of the foreign tax credit for dividends received, which we talked about earlier. So as you can see, there are many changes, a lot of new abbreviations,
terminologies,
not that we needed more, but we do have a lot of changes, especially in the international tax area. The biggest question right now is what are the states doing? We haven't seen any guidance so far from the states as to how they're going to treat the repatriation income and the FDII or GILTI. So, and the IRS also has indicated that they will release more information regarding GILTI, FDII, and the transition tax. So stay tuned on that.
I think here, I mean, at ASL, we're kind of adopting the process as it goes along, but I think extending, if you have foreign operations, it's really extending your return is almost a definite, because we don't even know what these forms are going to look like. The forms still have to be created and distributed by the IRS. So we're telling you what the law says, but as far as how the IRS is going to interpret it and what it's going to actually look like on your tax returns has not been provided. So there's a lot of questions. And as far as the state implications, that's one more reason why we need to wait to see how this all plays out. You don't want to be the guinea pig here.
Yeah. So, well, to sum it up for the 2017 tax year, we strongly encourage you to review your legal entity structure with us for any potential direct, indirect, or constructive ownership in the foreign corporation, because the failure to report the income inclusion or and to elect to defer the payment can result in substantial penalties, income tax, interest, etc., etc. Also, we do consider earnings and profit studies because it will just result in accurate calculation of the tax.
Right. I think that'll be one of the hot button issues for the IRS is was the EMP of the CFCs or of the controlled foreign corporations, was it calculated correctly? Because, I mean, that's the amount that's going to be repatriated. So it's either going to result in more tax for the IRS or less, but most typically more.
Yeah. I mean, historically, the earnings and profit studies were done only when the dividend was actually distributed by the foreign corporation back to the U.S. Right? So now it almost becomes like a necessity. Every corporation has to kind of do that.
Right.
So, so there are very significant provisions, and this will drastically change the way U.S. entities are taxed and conduct business abroad, as well as change how foreign companies will conduct business in the U.S. So we're waiting for more guidance. Stay tuned. If you have any questions, do reach out to us.
So we can, we have, I think, a couple Q&As here. So one is, what if my foreign company has negative accumulated earnings?
well, if your foreign company has negative accumulated earnings, I mean, there's nothing to bring back. I mean, there's no cash to bring back, right?
Right.
And
I think the EMP study will still need to be done, because to make sure that you do not have any positive EMP will be imperative. And so to do that study to determine that that's true, you kind of dot your I's and cross your T's, then there isn't going to be any EMP to be repatriated under that in the 2017
I mean,
filing
there's
season.
no repatriation tax,
Right.
right?
Another one. What if I have multiple controlled foreign corporations?
So if you have multiple foreign corporations, then net the earnings and profits. You have to kind of net it. So for example, you have 3 CFCs, two CFCs are have positive earnings and profits, and one has negative. You net it. The interesting thing is the CFC with negative earnings and profits, the measurement date is November 2nd. That was kind of interesting.
Mm-hmm.
So you net it. That's all it is.
Okay, so you're looking at it as a total activity.
Yeah,
And that's kind of true. Repatriation tax, GILTI, and FDII look at it all in that way. So if you have multiple foreign subs, you're looking at it in total as far as the calculations go. And I think we have one more question. What is high taxed income? I think this is referring to the GILTI calculation, and that was on step 1 of GILTI. That was one of the things that is excluded from. I guess we can go back to that slide. Just let me see here. Okay.
I think it's
So in this calculation of the tested income, there's one item in there that is you get to exclude a CFC's high taxed income. So what this amount is, the income that is subject to an effective foreign income tax rate of 90% of the maximum U.S. corporate tax rate. So considering the new 21% corporate rate, then the threshold would be 18, almost 19%. So that would be able to be excluded when you're doing step 1 on the GILTI calculation. So let's see if we've got any more questions. I think that's all we're getting in there. If you have any additional questions, please do reach out. When you do the little survey at the end, you can put your question in there, or please reach out to us directly and we can answer your question. I know we gave you a lot of information, and so you might need to process it and have additional questions, but we'll definitely be reaching out to our clients and having these discussions. So we really appreciate everything today, and
thanks for attending this webinar.
Thank you.